Hey, Mike, you know what's great about taxes?
What's great about taxes?
They're super stable, predictable, and they never change.
Yeah, that's right. Yeah, they stay. Yeah, that's right. I love that about taxes.
Yeah. Oh, wait. Bad news. Hey, it's 5 Minute Finance. I am Matt Robison, and this is our certified financial planner, Mike Morton, who is here to make things practical, simple, boil it down, make it easy to implement and get on your way. We don't lard you up with all kinds of optimization and crazy get your life perfect stuff. It's just get it done. 5 Minute Finance. Mike, don't people want to get their life perfect? And also, programming note, Matt, don't say, "Ooh, it's bad." Welcome to 5 Minute Finance. It's like that show, The Problem with Jon Stewart, and he's like, "Oh, there really should have been a comma after problem."
That's right.
Yeah.
Comma.
Ooh, it's bad. 5 Minute Finance would actually be a terrible name for a show. But it's a good name. It's a good name. Well, it's not really bad. It is confusing. Yes. But what you want to do today is you want to cut through the potential for confusion from the fact that the tax laws have changed once again.
Yeah, one big, beautiful bill. So this is, you've been reading about this for a while. So I thought today's show, we kind of break down the most important parts for the listeners here.
I want to give a caveat, a programming note up front. Mike and I have our own opinions about the one big, beautiful bill from a political standpoint, from a common sense standpoint. We're not going to inject any of that here. You may have your own opinions. At the end of the day, what matters is your tax laws have changed and it's going to impact your personal finance. So we're going to just try to look at it from that standpoint. So give me the bottom line up front here. What are people going to get in the next 20, 30 minutes here as we run through the one big, beautiful bill?
They're going to get our personal opinions and political views on the one big, beautiful bill act.
Oh no, it's 5 Minute Finance. Maybe we should call it Bohica. 5 minutes. Do you know what Bohica stands for?
No.
Bohica stands for bend over, here it comes again. So
again. I like the A at the end.
Yeah, we can once again, we might have to rebrand your show. So people are going to get a really practical shorthand rundown of what they need to know in the one big, beautiful bill.
Yeah. So today we're going to talk about some different areas, how they might relate to your personal financial and tax situation. So we're going to talk about brackets, the tax brackets. We're going to talk about the SALT cap. We're going to talk about charitable giving. The estate exemption is stayed really high. We're going to talk about family and kids, what kind of deductions and stuff you have for family. A couple other big picture items, and then potentially a few comments on our political view on the big bill.
I could almost picture people hearing your menu there and saying, I have a tax preparer who's going to take care of all this for me. But what I find personally useful whenever you give these rundowns of tax laws or, new provisions, stuff I didn't know about, is it helps me hear what might apply to me and therefore do a little bit of advanced planning. So it might change what you do if you know that one of these new tax provisions might apply to you. Is that right?
Yeah, that's exactly right. And also just where to pay attention. That's what I like about these kind of episodes. It's like, a bunch of it you may have heard of, a bunch of it may or may not apply, a bunch of it your tax preparer is just going to do for you, report on what's been done. But there'll be one or two nuggets, throughout the episode that you're like, oh yeah, I was just thinking about that. Right. Or I was curious if that was going to apply to me. And so you'll find those in this episode for sure.
Well, not to mention that there was so much reporting as this tax bill got put together on what was in it, what wasn't in it, and a lot changed at the last minute. So what you heard might not be what finally ended up in the law. And if that's not enough of an inducement for what's coming at you, Bohica, stay tuned because we're going to cover our usual listener question. This week, it's about 529s, college saving. Again, it's a situation of maybe this applies to you. You might want to perk up your ears. And of course, hang on for our one thing segment at the end where we will tell you, seriously, based on brain science, how to avoid having ChatGPT make you dumber. This is a real thing. I'm not making this up. Actual scientists are talking about this right now. It's one of the most downloaded papers out there in social science today. And it's interesting and it's worth knowing.
How you can become not dumber.
No, you don't want to go through a gradual process of dumbing.
That's right.
Wait, dumbing. That's not how you spell dumbing. And if you got that Simpsons reference, you are at least as old as I am. All right, let's get into it. So, brackets. You're talking about the NCAA tournament or?
Yeah, tax brackets, favorite subject. So the tax brackets and the standard deduction now became permanent. So these were when the law was passed in 2017. They were only temporary through 2025. Now they've been made permanent. Your 10%, 12%, 22%, 35, 37% are all permanent. And so that's a pretty big deal because we're in historically low tax brackets, and they're going to maintain that way. And then the other big thing is the standard deduction was doubled quite a few years ago. So many people now take the standard deduction, and that's also been made permanent. So the taxes going forward will be very similar to the previous few years.
All right. In terms of changing what people do and how they plan for the future, you're always telling people, look, you can get away with virtually any answer as long as you have a plan around it. Tell me how, when you work with your clients, information like this changes how you plan. Having foreknowledge that you're going to have relative stability for a while on tax brackets, relief from the tax cliff, and this bigger standard deduction. How does this affect your thinking for the kinds of clients you work with?
Yeah, I think in that case, it's knowing that we're in relatively low tax brackets and that they will continue for quite a number of years means I would continue to take advantage of income now. So if, doing Roth conversions is one where you can take the income now and maybe you're in the 24% tax bracket. 24 cents on the dollar is like pretty good to pay taxes. Yeah. So you can also do income recognition, say you have a small business and like, oh, should I take the income now or in the future? Now, these brackets are going to be kind of stable for a while. So less to worry about. And you just know your tax situation is going to be relatively stable, which is great.
The next one on your list was SALT. And Mike, I want to say NPEPA. I really want to say NPEPA, but this is actually a tax thing, but it doesn't apply to everyone.
Yeah, but it applies to a lot of people, especially kind of the people that I work with. So this is a really big deal. I just told you that most people took the standard deduction and not the itemized deduction. And recall, you take your total income, and maybe you have $300,000 combined all your income before taxes, and then you take a deduction. The government gives you like 30 grand off of that. So 300 minus 30, 270. Now you owe taxes on 270 grand. So you just get to deduct standard like 30 grand. That's great. You don't pay tax on that, and you just pay on the remainder. So you take your standard deduction, but if your itemized is more than 30,000. Then you get to subtract that. So if your itemized was 50,000, it would be 300,000 minus the 50. You pay taxes on 250. That's even less. That's even better. So the bigger deduction, the better. Now, within the itemized deduction, there was a cap, state and local tax, SALT cap. $10,000 was the most you could claim as an itemized deduction.
You could deduct that. Up to 10,000.
That's right. Up to 10,000 was the cap. And that's been increased to 40,000. And that's a big deal for people that live in states that have high income taxes, that have high property taxes, because it's state and local tax and your property tax adds in there. So you add your state tax. Hey, I paid 15, 20 grand to my state. I paid another 15 grand for property taxes. That's $35,000. So right there, you're, since the cap is now 40,000, you're able to deduct a lot more.
Wow. So that's huge. So it seems to me like one of the first things that could change here is that decision about whether you're taking the standard versus the itemized deduction.
Yep, correct. And this is where your tax preparer, is going to help you with that. Or if you use TurboTax, it's going to automatically always calculate those things. But you'll be in for a pleasant surprise. You can deduct probably 50,000 instead of the standard of 30,000, and you save tax on 20 grand.
Wow. So you'd say that lawmakers took a look at this and they said, ooh, baby, push it real good.
Yeah.
One last thing on SALT deduction. kind of per my previous question about brackets, will this change anybody's behavior? I mean, besides like on the margin, well, maybe I can move to a high salt, state because I got more of an itemized deduction now. I mean, is this going to change anything that people do? This new higher itemized deduction?
Yeah, it not this one specifically, but the charitable deductions we'll talk about come into play here a little bit. And the one thing I would say is it does phase out. So the $40,000, if you make over $600,000, $500,000 to $600,000, it phases out. So you're back at the 10,000 cap. So one thing that some listeners will relate to is the PTET. And if you know what that is, congratulations, this relates to you. But that becomes less important if you're in the $300,000 to $500,000 of income. But if you're still in like $800,000 of income, PTET is still a really big deal.
Okay. Well, you threw it out there, charitable giving. So let's go there now. More charitable giving write-offs.
Yeah, a couple of big changes here. Let's stick with the itemized deductions for a minute. So typically your charitable deductions come under the itemized. So if you're taking the standard deduction, not itemized, therefore your charitable deductions haven't been giving you any tax benefit because they only show up when you itemize. Okay? So if you do itemize, however, there's a catch here that now for high income earners, you've got a floor. You can't deduct all $5,000. You got maybe $500 or $1,000 that will not be deductible. So they give you a little bit of a kind of wacky there, like a little bit. So it's encouraging those with high income that are itemizing to give a little bit more.
The take home is a little bit maybe of a tiny tweak here.
Yeah, well, a couple other things. So this is not sticking on the itemized. The other one there is for those in the highest income brackets, 37%. You're capped at 35% in terms of charitable deductions. So you're again losing a little bit. So there's an opportunity if you do like to do a lot of charitable giving, if you are in a high income bracket, 2025 is actually a better year for doing that because those kick in 2026. So there's a planning opportunity. If you're high income and you do a lot of charitable giving, this is a good year to maybe bunch some of those using a donor advised fund or do more this year because you're going to get a little bit higher deduction this year.
A little bit more. Well, can I ask you a dumbass question? I mean,
as always, Matt. Yeah, of course.
Right, exactly. It's on my business card. I don't understand the deduction for charitable giving. It seems like one of those catch-22 incentive situations where if you have enough income that you can give a lot to charity, then on the margin, this kind of tax incentive isn't going to matter that much, especially with the caps involved. If you're not in that situation, then you're probably not going to be able to itemize deduction anyway. And so like the incentive's not going to apply. It just there's a big incentive for charitable giving. So the tax deduction for charitable giving even for high income earners is significant. So I'll give you an example. I've had a situation where we've donated $100,000 to the charity. So the charity got $100,000, but the couple only gave up less than $40,000 of purchasing power. Okay, so we gave away about less than 40 grand, but the charity got 100 grand. So that's the that's the tax incentive here to give to charities. You give up much less than the charity receives. I see. And was that because of the structure of the gift?
It's because of this. It's because the income tax deduction. So you deduct if you're 35% tax bracket, you save 35 cents on the dollar. So that's 35 cents right there. And then because it's appreciated, you can donate appreciated stock and you're not selling it for a capital gain. You save another 23%. So you're saving over 50% in the government's losing out on 50 cents and the charity gets the 50 cents.
Got it. All right. So there is something real and valuable to charities in here, even if it doesn't totally completely, if you're at the very highest end of the income bracket, doesn't totally change your life.
I don't know. It totally changes your life, but it changes the charity's life. It's a lot of money.
That's the point. And it's good for the charity. All right.
That's the point. The other quick one here is that I told you your charitable deductions, if you're taking the standard deduction, you don't get a tax benefit, but that's no longer true. So $1,000 or $2,000, even if you take the standard deduction, if you donate to a charity, 1,000 or single or 2,000 for a couple, you get to deduct that as well. So you get the standard deduction plus $2,000 more. And that's a great incentive because so many people are not itemizing, and now you are incentivized. Hey, if I give to charity, I'm actually going to, get a tax break as well.
Well, you buried the lead from my standpoint because this happens to me every year. I assiduously track, my expenses that are part of my LLC, and I track our charitable giving and all the other potentially deductible things if we're itemizing. And then our tax preparer comes back and says, you're taking the standard deduction, man. And I'm like, great, thanks. Speaking of being on the very upper end of the income distribution, estate taxes.
Estate exemption.
A little bonus here.
Yeah, a little bonus. So when you pass away, and you leave money, if you pass away, that's true. That's if you die, and you leave money to your kids. If your total estate was above, say, about $13 million and change, you pay no federal tax. You can if I'm passing all my money to Matt and I have $13 million and he gets all $13 million and no one pays taxes, and thanks everybody. And that was about to get set to be cut in half. So 7 million, which still is a lot of money, but that's a lot more people in the US, who have estates worth over 7 million versus over 14 million. Well, that got made permanent again. So the estate exemption is now 15 million and it will index with inflation. So if you are worth more than 15 million, then you do not have to pay any estate taxes when you die.
This is the portion of the program where I reserve all comment and personal perspective on the advisability of this as a policy, and we will move on to family and kids.
Well, let me
there's
just
some
make
good stuff in here.
Let me just make one more point on that because it's true. It's crazy. So I agree with that.
You're not mincing words. I am. I'm trying to okay.
But it is a big play. Look, we play within the rules that there are, right? So we just play within the rules. And it's a really big deal. Having a 15 million exemption is a big deal. There are a lot of people I've worked with that are above that. We do have estate planning to do. Right. And you can easily get above 15 million, guys. Like if you're just rolling your eyes at this, if you have a couple million now and you're going to retire in a few years, that is going to turn into over $15 million in 20 or 30 or 40 years by the time you die. So a lot of people do run into the situation, but good news, you can get ahead of it in so many different ways. So just take a look, depending on where you are, and if you need to start, doing some planning because it's going to, your estate is going to double and double and double over the next 40 years. Or a lot of parents, find themselves approaching that kind of situation, especially Matt. Both couples, you think like, geez, both couples, 30 million, we got 15 million each, 30 million, like we're totally fine. But if you don't plan and one person dies and the other person now has all the money, again, you can be getting close to that 15 million. So you got to do some planning.
Interesting. Right. I had never thought of that. Well, look, it is a good point. And this goes back to what we were saying at the top of the show, which is there's a whole bunch of things. And part of what we're doing here is just putting up a piece of fly paper. That's a gross metaphor to see, what sticks.
See what we catch.
Yeah, right. Exactly. See what we catch. And, you might find yourself exactly like you were saying, you might find yourself in a situation where, you're in a reasonably high income job, you do an extraordinary job of saving, you're doing great, and you're relatively young. And like you said, you have these assets that are going to appreciate. And by the time you pass away, this is going to affect you. So you play by the rules, and it's time for you to do some planning. So totally makes sense. Totally makes sense. All right. Family and kids.
All right, family and kids, we'll start running through these. The child tax credit went up a little bit, so that's great. It's going to be indexed with inflation. So everybody have more kids because you could save a couple $1,000 on your taxes.
That is definitely the determining factor. My wife and I, when we were deciding whether to have a third child, we were like, but what's going to happen to the child tax credit?
Yeah, child tax credit, man. How much are we going to get?
Yeah.
And then you got the Trump accounts, and we need to do a whole episode on Trump accounts.
We do. I have many, many thoughts, and I might be a little saltier about those, but they exist. Per your point, they exist.
They exist.
Play by the rules.
And you get, if you have kids between now and 2028, you get a free $1,000 from the government. So that's pretty nice.
It is interesting because I was talking to my wife about this, and we were done having kids. I'm 51, she's 48. But now that we could get a free $1,000 if and only if we have a baby in the next 3 years. We're thinking,
Yeah, now's a good time. Yeah, for her. Yeah, plus the 2,200 child tax deduction. I mean, come on, man.
We're going to be rolling
pretty good. And then the 529s changed a lot. So for you and I, Matt, and many listeners, 529s, they continue to make them more flexible, which is just great. Because I often get the question like, what if we overfund our 529? So they're more flexible. You can now for K through 12, they were capped at 10,000 per year. Now it's 20,000 per year. So way more useful in the pre-college years. And you can also now use them for a wider range of certificate training, certificates, development, certifications, stuff like that. Not just, accredited colleges, but they're kind of open to a wider range. And then, of course, you still have the Roth IRA, 35 grand you can put in your Roth IRA. So they continue to be super flexible, and I really like the 529s.
We'll put a pin in that thought about overfunding your 529s. We're going to revisit that shortly. But before we do, let's reach into the mystery grab bag. What else is in this bill that might be worth knowing about?
Yeah, 3 quick things that may or may not apply to you. You've heard the tips and no tax on tips and overtime. That does phase out with income, but you can get hopefully a tax deduction if you're getting tips and overtime.
For the next 3 years.
For the next 3 years, yep. I found interesting the car loan interest is deductible if your vehicle is a U.S. And that's not an itemized. So that is, again, just a line item deduction that you can get your car loan
that's
interest.
Interesting.
Yeah.
So let me just make sure I understand that. So if you took out an auto loan for the purchase of a car and it's U.S. assembled, you get an above the line part of your standard deduction. Below the line.
Yeah. Yep.
Wow.
Yeah, I believe that's the case.
Oh, that's cool. Actually, okay.
Yeah, that's pretty
the kind of thing that is like it changes the cost profile.
And again, you got to look up the details. I don't know them off the top of my head. Like, is it only for new cars? Is it in a certain time period? I'm not sure. Okay. But it caught my eye. It's like, I'd definitely look into that one.
Yeah. I mean, like, again, if you're comparing 2 different cars and, on the margin, you're trying to make a decision. It's like, look, you could get $1,000 off. It could change your decision.
Yep. And then another one for business owners, the QBI changed some of the rules, and especially around, I was reading about this, the depreciation and investing in R&D, they changed the rules that you can, take 100% of that R&D expense. So if you do have a small business, definitely look into the details of the QBI deduction and what you can expense.
All right. Any other thoughts, points?
No,
observations.
We'll skip our commentary.
No editorializing.
On the
all right, there
commentary.
It is. The OBBB.
Oh, you know what? I do have a download too, Matt. You should have led with that. If people are interested in kind of comparing, sign up for the newsletter, and it'll be in your inbox.
Awesome. All right. That is a useful cheat sheet. All right. Time for our listener question, which Mike already teased a moment ago. It was a tease on top of my tease. It's like a tease squared. If you have a listener question, you can just ask Mike if you're one of his clients, or you can email Mike at pod@mortonfa.com. Here is today's listener question from a real life listener. We've been saving in a 529 for our kids, but I worry about locking up too much money if they don't go the traditional college route. What options do we have? Great question.
Yeah, exactly. So there's a lot of options. So I still am very bullish on the 529s. First, so I'll just run through the ones I already kind of mentioned. K through 12, you can use 20,000 per year. So it's much more applicable, useful for the private schools or K through 12 years. Beyond colleges, they've now expanded it. So professional certifications, graduate courses. I've heard stories of people going to the Caribbean to a dive school for a month and being able to use their 529 for that. And they've expanded the uses in terms of kind of like room and board and other stuff as well. You can always put 35,000 into the Roth IRA. So 35,000, quite a big chunk. And so the beneficiary it's subject to Roth IRA rules. However, it's not subject to income limits. So you can make $600,000 and contribute $7,000 from your 529 directly to your Roth IRA, even though you're above the income limit from contributing your cash to the Roth IRA. So that's an interesting little twist. And then as always recommend, like, you can roll it to other family members, nieces, nephews, cousins. You can keep it for grandkids. And worst case scenario, you take it out for non-qualified expense. You pay a 10% penalty on the growth plus income on the growth because you haven't paid any taxes. You pay, taxes on the growth. So worst case scenario, you have money you didn't expect to have.
The big one to me is the rolling it to other family members. I mean, I have 3 kids, you have 3 kids. So it's like, I just don't see a scenario where we're not going to use this up on one of our kids. And the potential, which we covered in another episode, is available in the feed, to become your own little, multi-generational foundation, educational foundation for grandkids, other family members, is phenomenal. And again, there's like these other escape hatches. The Roth IRA one is big. So every time we talk about something related to this topic, it just comes back to your starter point, which is, I wouldn't sweat it too much. Like there's a lot of options.
Yep. Yeah, 100%.
All right. Well, let's get to our one thing segment for the day. And this is something that I am actually writing about right now. If you've ever wondered, if you're one of these subscribers to, Mike's newsletter, or you listen to this podcast, you're like, Matt Robison, is he just like in carbonite the rest of the time? And then Mike like unfreezes him, and he has hibernation sickness and can't see.
The answer is yes.
Yes, that is exactly what happens. That's why I'm bumbling around so much on this show. I do also, in the rest of my life, have a Substack. It's called Worth Knowing. It's at worthknowing.substack.com. That is the end of my plug. What I'm currently writing about is a fascinating new piece of research that comes to us from a paper called The Memory Paradox: Why Our Brains Need Knowledge in an Age of AI, and the TLDR on it, although I do hope people will read, is that it turns out that AI and Google search is very likely causing dumbing. It really is. There is a process. There's been a long-standing trend called the Flynn effect of IQ scores going up, especially in developed economies. And that's begun to reverse. And the number one reason that scientists ascribe it to is because we outsource so much knowledge retrieval to Google. We Google search for facts, we Google for do this math operation, and now we chat GPT it for it. So the take home is, yes, these technologies are likely messing with your brain's ability to do retrieval and to build up the kinds of mental processes that actually make you smarter. And the way to avoid it is to actually exercise your brain, look things up, and try to force yourself to recall them, quiz yourself, do a little bit of work, people. It's good for your brain, and it actually, according to scientists, will make you smarter.
And with that, my friends,
yes, with that,
the end of another episode.
Yes, this has been 5 Minute Finance, and Mike, I'm gonna go have a slice of pizza.
Thanks, Matt. Thanks for joining us on Financial Life Planning. If you like what you heard, please subscribe to and rate the podcast on Apple iTunes or Spotify or wherever you get your podcasts. It makes a massive difference. If you have a comment or question, please email me, mike@mortonfa.com. Until next time, thanks for tuning in. This recording is for informational purposes only and should not be considered for investment advice. Opinions expressed are as of the date of recording. Such opinions are subject to change. I cannot guarantee the accuracy or completeness of the data presented here.